Welcome back to Smart Capital Finance. The world is in prepared for what S quietly unfolding in the shadows of the silver market. While headlines scream record highs and analysts pat themselves on the back, a storm is building that no chart, no forecast, and no spreadsheet can contain. Factories will halt, contracts will shatter, and prices will leap violently without warning. By the time the mainstream notices, it will be too late. Deliverable silver is vanishing. Vaults are thinning. Strategic buffers are collapsing. And every second you wait is another opportunity lost to position before the chaos spreads. This is not a drill. This is a wake-up call. You think this is just a price spike, don't you? Wrong. This is far deeper. Silver isn't just an investment, it's the lifeblood of modern industry, silently powering electronics, EVs, solar grids, satellites, and defense systems. A single ounce going missing isn't a trivial hiccup. It's a structural breakdown waiting to happen. For years, the market has relied on a fragile trick, pulling from above-ground inventories whenever mine output or recycling couldn't meet demand. That buffer is gone. The strategic cushion that once absorbed shocks has evaporated. Each vault report, each delivery contract, each industrial allocation is now a countdown clock. One missed shipment, one delayed contract, one licensing change anywhere in the world can cascade into a global shortage. And yet, most people are still staring at charts and headlines, blissfully unaware. They treat silver like it's just another commodity, ignoring that industrial demand doesn't blink at prices. Procurement managers don't wait for the news. They act first, silently, aggressively. Hoarding isn't greed, it's fear. Fear of disruption, fear of shutdown. And when fear hits industrial supply chains, it moves faster than any retail FOMO ever could. Meanwhile, the mainstream narrative reassures you. Supply will meet demand, don't worry, but it won't. Paper silver can be printed endlessly, but physical silver is finite. And when the system's physical reality collides with paper promises, chaos isn't just probable, it's inevitable. The math is cruel. 5 consecutive years of supply deficits, thinning registered inventories, concentrated refining pathways, geopolitical friction, and corporate panic all combine into a single outcome. Volatility spikes, premiums blow out, and the first wave of unprepared participants gets crushed. By spring, when procurement cycles collide with limited availability, every ounce will be fought over, and price will no longer be a reference. It will be the enforcement mechanism. Scarcity won't whisper, it will roar. So what does this mean for you? It means that everything you thought you knew about silver is already obsolete. The price on a screen is meaningless if deliverable ounces don't exist. Vaults, strategic stockpiles, and above-ground buffers are not decoration. They are shock absorbers, and they're collapsing. Imagine this. The U.S., once a master of strategic depth, has liquidated 73% of its protective reserves over decades of complacency. What once shielded the nation from supply shocks now leaves it exposed to the whims of global supply and concentrated refining hubs. If a single licensing tweak occurs overseas, if a single refiner prioritizes domestic buyers, the ripple hits instantly, and the U.S. market feels it first. Now layer in industrial panic. Manufacturers don't tweet, they buy. And when they buy under stress, they don't buy what they need. They buy what they fear they might need. This isn't speculation. This is operational survival. Contracts are renegotiated at higher prices, production schedules are accelerated, and everyone who hesitated is left scrambling at the back of the line. Even substitutes and recycling can't fix the problem. Recycling is slow, redesign takes months, certification years. The moment scarcity hits, price becomes the rationing lever. And make no mistake, industrial buyers can absorb far higher prices than casual investors imagine. That means silver could spike violently before anyone outside the system notices. Spring isn't magical. Spring is the collision point, when contracts mature, procurement cycles peak, and buffers are tested. By then, the market has already repriced itself, silently and invisibly. Public headlines will only reveal the smoke after the fire has consumed supply. This is the moment where positioning matters. The quiet, preemptive moves, buying ahead of panic, tracking registered inventories, monitoring premiums, and anticipating procurement deadlines, determine who survives the next spike and who pays the price for hesitation. Let me take you through the anatomy of this system collapse. Picture a global supply chain dependent on silver. Every EV battery, every solar inverter, every microchip, every high conductivity contact, every satellite circuit, all of them sip silver like a city sips water. Individually, it's a minor cost. Collectively, it's a system-wide dependency. For decades, governments and corporations relied on buffers, strategic stockpiles meant to absorb shocks. The U.S. held reserves not for profit, but for survival. Silver was treated like oxygen, essential, irreplaceable. Then came decades of complacency. The Cold War ended, budgets tightened, and strategic reserves were sold off. Insurance was converted into short-term savings. Dollars replaced resilience. Today, that resilience is gone. 73% of strategic depth evaporated. Above-ground inventories are no longer a safety net. They are a fragile remnant. Every small disruption now magnifies into massive consequences. Meanwhile, the global market has structural tightness baked in. Mine production and recycling run at a deficit. Registered inventories on exchanges are declining. Refining and processing are concentrated in a handful of hubs, creating leverage for whoever controls them. Geopolitical friction, licensing tweaks, and trade policies are no longer abstract. They are instant market-moving events. Industrial buyers, the silent giants of the market, react before the headlines. They don't care about trends, they care about operations. A missed delivery could halt a factory. A late shipment could derail a multi-billion-dollar project. When they sense scarcity, they hoard. Not greed, survival. Paper markets continue quoting prices, but these are illusions. Real metal is finite. As registered inventories drain, premiums explode. Delivery delays extend. Smaller participants get squeezed first. Every transaction becomes a negotiation. Price is no longer a number. It's a tool of rationing. And then comes spring. Procurement cycles peak. Contracts are finalized. Production schedules lock in. Any disruption at this moment, the geopolitical, logistical, or financial, translates immediately into industrial panic. Buyers compete aggressively. Markets reprice violently. Volatility spikes. And the public watches the aftermath, seeing only headlines after the fire has spread. Consider this. Major institutions predicting 135 silver by spring aren't pitisomati giving optimistic targets. They are signaling that professional models anticipate pressure building in the real world. Their signals assume order, but order rarely survives scarcity. Delivery failures, panic buying, and concentrated refining control can escalate prices far beyond their expectations. This isn't theoretical. In past weeks, over 33 million ounces were pulled from deliverable inventories in a single week, a warning light blinking in real time. When official buyers step in to rebuild strategic reserves, they don't calm the market. They tighten it. Every ounce they claim reduces open market float, amplifying volatility. Industrial panic and investor FOMO create a feedback loop. Panic begets panic. Supply constraints amplify demand. Price spikes until rationing occurs. And unlike retail traders, industrial buyers won't stop until their operations are secure. That's how system-wide repricing unfolds. Fast, silent, and merciless. Here is the brutal truth nobody wants to say. The silver market isn't broken by speculation. It's broken by structure. By spring, the buffers that once absorbed shocks will be gone. Deliverable metal is vanishing faster than public perception can keep up. Industrial buyers aren't waiting for headlines. They're locking in supply, silently, aggressively. Every ounce they claim removes liquidity from the open market. Every contract finalized is a countdown towards scarcity. Consider the industrial web: EVs, solar grids, satellites, defense systems, high-performance electronics. Each consumes tiny amounts of silver, but across billions of devices, millions of vehicles, and countless infrastructure nodes, those ounces add up into systemic dependency. When buffers thin, even a minor disruption magnifies exponentially. One delayed shipment can ripple into global shortages. Geopolitics compounds this risk. Refining hubs are concentrated. Licenses, export controls, and political friction are invisible levers that can instantly redirect supply. The U.S., once insulated by strategic reserves, now relies on external flows it doesn't fully control. And every policy tweak anywhere in the supply chain translates immediately into operational panic at home. And now layer in human psychology. Industrial buyers don't tweet about shortages, they buy. Not what they need, but what they fear they might need. That's how a slow squeeze becomes a cascade of panic. Paper prices may quote stability, but when deliverable ounces disappear, price becomes a rationing tool, not a signal. Premiums blow out. Delivery times stretch. Smaller participants are squeezed first. The screen price is no longer information, it's a negotiation. And when official buyers, governments, large institutions, move to rebuild reserves, the market doesn't calm down. It tightens. Every ounce they purchase shrinks the float further. Volatility accelerates, stress spikes, overshoots happen, and the public sees only the smoke after the fire has spread. This is the math of tightness. This is scarcity under pressure, and it's invisible until it hits. The 73% collapse of strategic reserves isn't a statistic. It's lost optionality. It's the difference between absorbing disruption and being forced to pay whatever the market demands. It's why spring procurement cycles matter. Contracts collide with reality, buffers fail, panic spreads. By then, positioning late in the game costs everything. Now here's where you come in. You can't wait for headlines or rely on mainstream analysts. They report after the fact. You need to track real signals, vault inventories, deliverable metal, premiums, contract timing, and industrial flows. Watch who's buying, not who's talking. Watch the gaps between paper claims and physical availability. That's where opportunities and risks collide. Ask yourself, when the next move hits, will you be the observer or the participant? Industrial panic will lead investor FOMO. FOMO will amplify panic, and the first movers, those quietly positioning ahead of the noise, will gain the advantage. Every second counts. Scarcity doesn't wait for convenience. Comment below, which comes first, industrial panic or investor frenzy? Whichever triggers the other first defines the next violent leg up in silver. Don't underestimate the feedback loop. Fear begets fear, scarcity begets scarcity. If you can see it before the crowd, you can act before the market snaps. This is where awareness becomes action. The market punishes hesitation. It rewards anticipation. And spring isn't a date, it's a window. Miss it, and the consequences are baked into every industrial contract, every vault withdrawal, every spike in premiums. And here's why the cycle repeats. Once scarcity hits, the market reprices violently. Buyers compete. Delivery stresses explode. Exchanges stretch timelines. Headlines lag behind reality. Panic triggers more panic. Industrial buyers secure metal aggressively. Investors chase FOMO. Every ounce withdrawn reduces future float. Every panic purchase increases the pressure. The system is self-reinforcing. The more people see scarcity, the more they hoard, the tighter the market becomes. Paper claims mean nothing. Only deliverable metal matters. And when that's gone, the next signal doesn't come from charts. It comes from factory delays, missed shipments, and premium spikes. Watch the buffers, watch the flows, watch who moves first and who hesitates. Because in a market like this, hesitation is cost. Scarcity under pressure doesn't wait. Spring procurement deadlines, industrial panic, geopolitical leverage, shrinking reserves, they all loop back, creating the perfect storm of volatility. Remember, the public sees smoke after the fire. If you want to stay ahead, you need to act quietly, monitor relentlessly, and anticipate before the chaos hits. Every second the market is calm as a window. Every delay in perception is another opportunity lost. The narrative is simple. Scarcity grows, panic spreads, price snaps, and the system repeats, louder and more violent, until the baseline itself shifts. This is Capital Finance. Watch, learn, position, survive.